Hi folks, and welcome to our presentation on share retirement. Many times we're asked to do several examples of share retirement for students because some of them find it a very confusing topic. So hopefully this video will help you to make a little more sense of it and make you more confident as you move into doing other questions that relate to this topic. So let's begin. In this case, we know that Benson had the following balances in its equity accounts at the end of December 2012. They tell us that their common shares were on limited authorization and there were 181,000 shares issued and outstanding, meaning they were with shareholders. And in return, to get those 181,000 shares, our shareholders gave us in total $2,172,000. We also know that our retained earnings is $250,000. You can see here that during 2013, we had several transactions where shares were retired. April 13th, we repurchased and retired 5,000 shares, and on May the 9th, we also repurchased and retired shares, but this time it was 9,500. We also had on September the 20th, a 2-for-1 share split. So what we want you to do is to journalize each of those three transactions, and then we want you to put together a statement of changes in equity as well as the equity section of the balance sheet. So the first thing we're going to do is we're going to do our journal entries for each transaction. So here in April the 13th, if we're taking these common shares out of the hands of our shareholders, then what we need to do is we need to take them off of our books, right? So you know that when we issue shares, we credit common shares. So therefore, when we buy them back from our shareholders, we're going to have to debit common shares. The question becomes, for how much do we debit our common shares? Well, you always debit your common shares for the amount of shares you're retiring multiplied by the average issue price. The average issue price can be calculated using the total amount that our shareholders gave us divided by the total number of shares that are issued and outstanding. When we do this calculation, we'll see that we have on average $12 per share that we got from our shareholders. Now, once we take that $12 a share, multiply it by the number of shares that we took off our books, that means we're going to debit our common shares for $60,000. Now, we have to balance this debit entry with a credit or two. So let's look at how we figure this out. Well, how much did we pay our shareholders to buy back the shares? Well, we paid them $9 a share. So that means if we took shares off of our books and we paid our shareholders $9 a share for each of those 5,000 shares, that must have cost us cash of $45,000. So now, to make the total dollar of the debits and the credits equal, we know that we need a $15,000 credit here, but what are we going to credit? Well, whenever you pay less to buy back the shares than what your shareholders gave you, meaning in this case, if we only bought them back for $9 a share and our shareholders on average gave us $12, then we've got to credit an account called contributed capital for the amount. So that contributed capital account was created on common share retirement, and we're going to credit it for the difference, which is $15,000. So that's what we plug up the difference by. Now, again, I've explained down here that because we paid less, which is $9 a share, to retire the shares than what our shareholders actually gave us, which was on average $12 a share, this is going to create or increase our contributed capital on common share retirement by $15,000. Okay, so to increase an equity account, we are going to credit it. All right. Now, on May the 9th, we did the similar thing, but this time we repurchased 9,500 common shares and canceled them at $13 a share. So now we know that the average issue price of our shares was $12 a share. So we're going to debit our common shares or take those common $9,500 common shares off our books at $15 a share. So therefore, $9,500 times $12 a share is $114,000. What did we pay our investors to buy the shares back from them. Well, in this case, you'll notice it says that we paid more than $12 a share. We actually paid $1 a share more, which was $13. So we paid more to our shareholders to buy the shares back than what they gave us. So in this case, this is why we have a debit here. Once we credit our cash for the total amount that it cost us to buy back the shares, which is $9,500 times $13, or 9,500 shares times $13 a share, that means we have to shore up or even this transaction out so that total debits and credits are equal by making a debit entry. So what's the account that we would debit? Well, because we already have contributed capital on common share retirement, we start to draw down on that. We have $15,000 built up there, so what we're going to do now is we're going to start to draw down or debit that account. Why that account? Well, because it was a common share retirement that created contributed capital. So therefore, if we need to draw down on any contributed capital for a common share retirement, as we have on May the 9th, we can draw down on that account because we have some, right? So if we have some money in the account, we can draw down on it, but only to the extent that we have it.